Good morning. This is Horizon's Middle East and Africa, our top stories this morning. Greenback in the red. The dollar emerges as the latest victim of this week's market mayhem, falling to a 6-month low as investors seek havens in the worsening global trade war. Recession fears, frantic selloffs hit U.S. stocks and bonds as Wall Street loses confidence in the economy despite President Trump's 90-day tariff pause. And oil sell-off gathers pace, heading towards its second weekly loss as global growth fears mount. Well, it's just gone 8 a.m. across the Emirates. I'm Jumana Bersachi in Dubai. What can I say? That relief rally didn't last very long. We saw that big bounce yesterday, the day before yesterday, I should say. But by the close, what we did see was another round of selling, heavy selling across all U.S. assets, not specific to U.S. equities. We also saw selling in the USD and selling once more in fixed income. So there's a much bigger move going on here. But just to point out that S&P ended down 3.5%. We were down 7% since that tariff liberation day, so to speak, about a week ago. So markets still trading very, very heavy. Today, things stabilizing somewhat. S&P trading sideways. The NASDAQ also futures trading sideways. We also had data coming through yesterday. The CPI figures lower than expectations. In normal times, that would be cheered on by the markets. But the market attention, obviously now, is very much on tariffs and what happens and whether that 10% broad-based rate is going to be lowered and whether these deals that President Trump talks about are actually going to come into fruition. So that's a focus for markets. Your stock futures is surprisingly leaning towards the green. I would say up 0.4%, and namely because there is some scope there for deals to be hashed out between the EU and US, and certainly the Europeans have been a lot more dovish in their approach to the U.S. than other blocs around the world, namely China, of course, which have taken a much more confrontational approach. And then today, the handover from most of the Asia-Pacific stocks is negative 0.9%. The Nikkei down 4% today in trading. But switching over, I did mention that pretty much all U.S. assets have been sold. U.S. Treasuries, once again, in focus today. We're trading at 4.4. We're about 1.5 basis points higher. Yesterday, the 30-year yield really tracked a lot higher, about 13, 14 basis points higher. There was an auction that cleared through the level that it went into. So, i.e., there was demand at these levels. But the point is, we have moved a long way. We're up about 30 basis points in the last couple of days for U.S. Treasuries. That's not a normal move when risk is selling off. The dollar squarely in focus. Today down 0.6%. Yesterday, the DXY dropped 1.2%, its biggest drop in 3 years. And what you're seeing again is perhaps some form of a de-dollarization move going on. Money is going into euro. Euro trading 2.5% firmer yesterday. The yen also was a beneficiary from all of these flows out of the U.S. Safe haven Swissy seeing its strongest day since 2015. So some really big superlatives here going on in the FX space. But all this to tell you that the USD continues its decline. And then gold, once again, reaching an all-time record high, 1.3% firmer this morning. And Brent, as you can see, hovering around the $63 level, but on track for weekly, its second weekly week of decline. So oil and energy complex continues to come under selling pressure here. All right, let's pick up the conversation and take a look at how some of these Asian markets are faring. Avril Hong is in Singapore and break it down for us. So far, the handover seems to be somewhat mixed, but leaning towards the reds.
Yeah, I mean, it's not just today that's been in focus, right? Much of this week, Asian markets have been on such a ride, given the tariff twists and turns. And then the White House in the past day clarifying that it's going to be 145% on China. Trump himself saying there are going to be some transition issues. So it's really interesting on a day like that, while the region's benchmark is headed for weekly declines, that we're actually seeing Chinese stocks not faring that badly, to your point about it being quite mixed. Maybe the idea that amid all disruptions, the chief casualty is ultimately going to be U.S. assets. So in Chinese assets, they're actually looking quite composed. We had the yen rallying, of course. You talked about it a short while ago. That's the pressure that we're seeing on Japanese stocks as well. The Nikkei declining upwards of 4%. Jumana?
Avril, thank you so much. Avril Hong in Singapore. Well, President Trump says he is hoping to make a trade deal with China. This comes as the White House confirms the tariff rate on most Chinese goods is now at 145%, deepening the trade war between Washington and Beijing. Bloomberg senior editor Bill Ferries joins us from Singapore. Bill, it's really difficult to piece together, I guess, what the Trump administration is thinking and how they're responding to these financial markets. But one thing that President Trump did say the day after they announced the 90-day pause is that the bond market is now beautiful again, which tells us that he actually was watching the moves in bond markets. And once again yesterday, we saw a massive spike up in yields. Do we think that the Trump administration may respond once again to some of the havoc that's taking place?
Well, publicly, Trump and his team are expressing confidence. The president admitting that there might be some, quote, transition problems as he goes forward with these tariff plans. But when he was asked on Thursday about the stock market decline, he said he hadn't been looking at it at all. I'm sure behind the scenes there's a lot more discussions going on, but it's clear that the president wants to press forward. He clarified about the higher tariffs on China. And I think there's going to be a lot of focus both on how the China ties go forward, but also how these negotiations with some of the countries that the Trump administration believes want to make deals will go in the coming weeks.
Yeah, I thought it was interesting. I was reading one of the articles on the terminal today saying that the Vietnam Deputy Prime Minister is actually going to be meeting with the Treasury Secretary, Scott Bessent, and Howard Lutnick to talk about negotiations around a trade deal. What's happened to Peter Navarro? Who should we be watching in this administration to get clues on what happens next from here?
Well, as you know, Peter Navarro was really the architect during the campaign and even in the last few weeks of this tariff plan. He takes a very hard line. He talked about having tariffs on China of 400% or more. It's a little early to say with all this turmoil whether we've kind of reached peak Navarro, but it's clear that Scott Bessent is coming to the fore as the top administration official, along with Howard Lutnick, to begin the negotiations. It was Bessent who proposed that perhaps Japan jump near the front of the line because they had come forward with some potential deals to help alleviate the tariff pain. I think we're going to be seeing a lot more of him, particularly if the markets continue to be as volatile as they have been this week.
Yeah, and certainly he seems to have emerged into a more prominent role given how much market volatility we've seen and his background. Bloomberg senior editor Bill Ferries, thank you so much. Well, to pick up the conversation and to discuss a little bit more about what's been going on in FX, some really big moves yesterday. Joining us now is Paul Mackel, Global Head of FX Research at HSBC. Good morning to you, Paul. Thanks for joining our program. You know, just looking at the price action yesterday tells me that investors really aren't going to stop until there's a resolution on the tariff front. We thought that perhaps the 90-day pause would be enough to allay people's concerns. It turns out that isn't the case. Are markets going to keep pressing the Trump administration until they fully back down on either the tariffs or bring some deals to the table?
Well, there's no question we're seeing some wild movements in the currency market because we become so accustomed to think that when you see risk aversion, that the U.S. dollar should be doing quite well. But that's not been the case. We've been seeing different episodes of that through the course of this year. But over the last week, we've seen even more, what can I say, a diabolical type price action, the way that the dollar is struggling when U.S. equity markets are not looking very good and Treasury yields are going up. That's not a good combination. When that happens, that's usually a signpost of something quite more concerning around the corner.
Is the USD facing a crisis of confidence? Is that what is happening here? Because you've got the likes of Larry Summers putting out a post on X saying the way U.S. assets are behaving today is akin to an EM playbook. You typically, in times like this, you would get money pouring into the USD. That's not happening. People are shedding USD assets left, right, and center. Is there a crisis of confidence here?
Well, it's an interesting question, and people are asking that more and more because exactly from this type of changing correlations that are happening in the financial markets right now, Why isn't the dollar actually doing better? No, in our view, the way that we've been thinking about it, as long as you're having this ongoing U.S. economic policy uncertainty, that's coinciding with downward pressure on the dollar. So unless we get some sort of indication that this type of economic uncertainty can calm down, then the dollar is likely to be on the back foot. But against what? And I think what's been happening is you're getting a bifurcated dollar playing out. And I think that's going to continue.
Yeah, what I find interesting out of all of this is I wasn't surprised to see money go into the other safe havens, the likes of the yen and Swiss franc. Obviously, huge days for those two yesterday. But a lot of money is going into the euro. We were just showing now that even today, the euro is up another 1.2%. Is money going into the euro because people think Europe is going to be better off, or simply because Europe is not the U.S.?
Well, I think markets are trying to find an anti-dollar, so to speak. And that's often how we've been viewing the euro over the last couple of decades. That if you don't like the dollar, well, what's the next big choice to like? And that's going to be the euro. So I do think it's been a story of benefiting by default rather than merit. I mean, there's not really a growth story that's going on, but there's been this release valve that's been playing out in the currency market, and that's been supporting the euro. As I said, I think this is probably going to keep continuing as long as we have this economic uncertainty unfolding around the U.S.
Yeah, a lot of focus in FX space on the yuan fixing and the fact that it is starting to creep higher, the authorities allowing that to happen. And again, a distribution of views as to what may happen. There are some people in the street saying that China may pursue a shock depreciation in an attempt to counter the impact of the tariffs. And others say that they will keep it a managed depreciation so that they don't prompt too many capital outflows. What is the house view? What do you think happens with the renminbi?
Well, we've never been a believer in the shock depreciation story around the renminbi. I mean, even going back to 2015, when there was a depreciation by the currency, many people were jumping on board that it's only going to get worse and worse and worse. And we push back against that, and we still do. So, yes, I do think there can be a managed descent for the currency over the coming quarters. But even in the last day or so, what you have been seeing is that the stability in the exchange rate appears to be coming back. So it's not manifesting in this depreciation story that perhaps some have been concerned about. So as I said, I push back against this devaluation argument that people have been thinking about for some time.
Yeah. Let me just round up by asking you one, I guess, simple question, Paul, which is, what do you think it's going to take for markets overall, not just FX markets, to stabilize from here onwards? What do we need to see?
I think there's a few things. One is, can we see some stability in U.S. assets altogether? So I think that's the first thing. But when you're getting this combination, as I said, weaker dollar, higher treasury yields, and also U.S. equity market weakness, that's a source of discomfort. So if that were to actually just calm down, I think then markets would begin to pause and reflect. The second thing is what you've been referencing too is on the policy side. What's next from the U.S. administration with regards to tariffs? Are they looking to increasingly negotiate with more countries and some kind of calming down of the overall backdrop of this? That would be helpful. Then the third thing we'll be paying close attention to is the hard data in the U.S. Can it hold up or not? There's a lot of doubts there, but I think that's what we need to be looking at for next.
Yeah, excellent. Paul, thank you so much. We really appreciate you coming on our show today. Paul Mackel, Global Head of FX Research at HSBC. Now, a helicopter has crashed into New York's Hudson River, killing all 6 people on board. City officials say the passengers, including 3 children, were from Spain. The helicopter's flight path shows it had flown around the Statue of Liberty and George Washington Bridge before the crash. It is the latest in a series of recent incidents rattling confidence in U.S. aviation safety. And still ahead, Israel is planning to take full military control of Gaza. The details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Bersecci in Dubai. Israel is planning to take full military control of Gaza, which officials believe will improve the chances of eliminating Iranian-backed Hamas. But this strategy risks further increasing the death toll and isolating Israel. Bloomberg understands that plans were drawn up last month by the new military chief, Eyal Zamir, and approved by the defense minister, Israel Katz. Joining us now is our managing editor for Middle East and North Africa, Onur. And Onur, what do we know about Israel's plans, supposedly, to fully take over Gaza?
As you said, Jumana, these plans were drawn up and approved by the new military chief and somewhat new defense minister in Israel, but they haven't yet been approved by the cabinet in Israel. Now, having said that, we have seen over the last 2 months, since pretty much the truce broke down, Israeli troops, unlike in the past, as they moved deeper and deeper into Gaza, they have not retreated from their positions after being deployed there. And we are seeing that possibly 50% of more of Gaza right now is under the control of Israeli troops that have been deployed there gradually over the last couple of months. The idea seems that the direction is clear. As you said, there is a plan for military occupation of Gaza, much like the West Bank is. But on the other hand, it can also serve as leverage for Israel if it chooses not to do it in the future, but instead uses this source of pressure to pressure Hamas release the remaining hostages, who are believed to be around 24 of them are believed to be alive, as you know.
Onur, talk to us about what's been happening between Turkey and Israel. They've been butting heads, so to speak, in Syria. And the Turkish foreign minister a few days ago accused Israel of pursuing expansionist policies. And yet we hear now that there are going to be discussions taking place between Israeli officials and Turkish officials. What are they going to be talking about?
Well, the first contact already took place in Baku, out of all the places, because it's a country that is friendly to both. And I should remind you that this contact took place right after U.S. President Trump actually offered to mediate between the two countries. What is important to note is that, yes, they have huge differences, but they're not meeting to overcome those differences in political matters or over their policies in Gaza. This is purely a deconfliction mechanism at the moment. And that means that they just do not want Israeli and Turkish troops to start shooting at each other in Syria and keep doing that until there is a new war in the Middle East. That is the gist of the new round of talks.
And indeed, it also reportedly came up in the conversation that Netanyahu had with Trump this week, and Trump said, you guys have to sort it out, essentially. He doesn't want to see problems. Onur, thank you so much. Onur Ant, managing editor for Middle East and North Africa. Now, coming up, after tariffs hit some of the poorest countries in the world, could military aid in Africa be cut next? We find out next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. African countries are worried that the U.S. may withdraw military aid after slapping some of the poorest countries on earth with steep tariffs that could set back operations against armed rebel groups. Now, Bloomberg's chief Africa correspondent Jennifer Zabazaja joins us from Johannesburg. So this is interesting because we've been talking about the tariff impact, but of course the U.S. have been cutting back on aid as well, even military aid. What has the partnership looked like over the years between the U.S. military and many of these African countries that you follow?
Right, Jumana, it's been quite significant. I mean, let's just start with the financial contributions that we've seen. In 2024, the White House stated that they were spending upwards of $73 million on some of the security operations. If we move away just from the financial contributions, though, the activities were wide. I'm talking about things like security operations. There was humanitarian assistance. There was peacekeeping efforts. There was also military training and exercises for many of these African nations that in and of themselves do not really have security or excuse me, military apparatus that they're able to withstand on their own. They're a bit fragile. And so for the U.S., this has been something that they have prioritized and said that it is mutually beneficial for a lot of these African nations. But not just that, it is, of course, strategic for the U.S. If we just take a look at the African continent, there is, of course, many ports ports and waterways that are very strategic for the U.S., but also there's a number of U.S. personnel that are on the ground here. And so the U.S. has said this has been significant, not just for the country, but also for a lot of these nations. And so that is why this concern is coming up, because if we do, in fact, continue to see more of this aid being eroded for the African continent, and it begins to start tapping into a lot of the military assistance that we've seen here, we could start to see the rise in many factors that the U.S. has at least tried to prevent over the past few years.
Yeah, I mean, ultimately, what does the stripping of this assistance, both economically and militarily, mean for the region?
The biggest concern, if we take a look at what we've seen over the past few years, of course, is if the U.S. steps back, we see other actors such as Russia, China, and other Islamic insurgency groups stepping in to fill some of those gaps. That has been something that the U.S., at least in a soft power capacity, but also physically, has tried to prevent over the past few years. But in some parts of the region, the Sahel, of course, there has been Islamic insurgency that the U.S. and others have been trying to prevent. There's Boko Haram in parts of West Africa. And of course, there is we've covered a lot of the wars and the regional wars and the infighting that has happened. And so potentially we could see a rise in that if we do continue to see U.S. military personnel moving away from the continent. And so that is really the main concern. And a lot of this is coming from a summit that we saw earlier this week where leaders are saying they don't know if they're going to see the summit happening again. They've talked about it in the past and how it's been a priority from the U.S., but they haven't gotten any security or any assurances that it's going to happen next year. So that is really where this is stemming from. So a lot to pay attention to moving forward.
Yeah, most definitely. Bloomberg's chief Africa correspondent, Jennifer Zabazaja, thank you so much for the reporting there. Now, Nigeria says it expects to exit the dirty money watch list this year. The West African nation passed a new investment law to regulate cryptocurrencies. Financial Action Task Force had placed Nigeria on its so-called grey list over its money laundering practices and lack of digital assets regulation. Okay, let's turn back to markets now. We saw yet another big risk-off session for markets yesterday with both the S&P and the Nasdaq pulling back, all U.S. assets getting shed, really. U.S. Treasuries sold off, the dollar getting sold off. But take a look now. We're seeing some stabilization come through. S&P futures are actually leaning towards the green. So maybe the worst is over once again. It's very difficult to say at this point, but the futures are pointing to a more positive start to the day for European equities and for U.S. equities. We'll have more on this market price action in just a moment. But coming up, we're going to be talking about oil because it's heading towards its second weekly loss. We discussed with Macquarie's global energy strategist next. This is Bloomberg. Good morning. This is Horizon's Middle East and Africa, our top stories this morning. Greenback in the reds. The dollar emerges as the latest victim of this week's market mayhem, falling to a 6-month low as investors seek havens in the worsening global trade war. Recession fears, frantic sell-offs hit U.S. stocks and bonds as Wall Street loses confidence in the economy despite President Trump's 90-day tariff pause. And oil sell-off gathers pace, heading towards its second weekly loss as global growth fears mount. It is just gone 8:30 a.m. across the Emirates. I'm Johanna Bersachi in Dubai. The relief rally for equities didn't last very long. By yesterday's close, we had both the S&P and the Nasdaq pulling back, losses of around 3%, 4% respectively. S&P now down 7% since that tariff liberation day, so to speak, just over a week ago. So still, investors sitting on a lot of losses, but things seem to be stabilizing in the overnight session. Take a look at this. S&P futures, Nasdaq futures up about 0.2%, 0.1% respectively. European markets also seen opening up in the green, which is interesting because the sell-off really accelerated after European markets were closed yesterday. So you'd expect there to be some form of a catch-up, but not the case. And maybe it's on the back of markets participants pricing in the potential of a deal or some form of a de-escalation of tensions between the EU and the US. So take a look at that. But overall, the handover from Asia Pacific, though, still pretty negative, with many of those countries, specifically China, is still in the eye of the storm. Switching over, big moves yesterday once again, but dollar really caught my attention, trading weaker once more this morning, down 0.5%. Yesterday, the DXY versus a basket of currencies dropped 1.2%. That was its biggest drop in 3 years. The dollar continues to get sold. Money is going into euro, into safe havens like the yen, like the Swiss franc, at levels that we've not seen in the past couple of years. So these outflows from U.S. assets appear to be accelerating, and that is one of the reasons why the USD is trading weak. At 10-year yields as well, similar theme playing out there. You also saw some more selling go on in that space. 30-year yields up about 30 basis points over the course of this week. And of course, we know that the Trump administration is watching the bond market very closely. So all eyes to see on how they respond to these latest jitters. Brent very much in focus as well. Today, we're only down about 0.4%, but still wild moves in the energy complex, down more than 20% over the last couple of trading days. So a lot of downward pressure being put on oil and that part of the market. And then gold, the safe haven, everyone's favorite, it continues to do well, all-time high, up 1.2%. I just want to show you very quickly this chart on the USD, though, because I think this really encapsulates how bearish market sentiment is right now on the dollar. And in terms of sentiment and in terms of risk reversals, i.e. people hedging to the downside, buying downside protection on USD, the traders or the options market would imply that bearishness is the most it has been on the USD in 5 years. So all of this has happened over the course of the last few months. U.S. exceptionalism gone for the time being. All right, Abu Dhabi's Mubadala Energy will buy its first ever stake in U.S. natural gas output. The company is buying a 24% interest in Sotex Holdco, which operates a shale gas field and is planning a liquefied natural gas export terminal in Louisiana. This deal comes after the UAE pledged over $1.4 trillion of investments over 10 years into the U.S. So geopolitics at play. Now, meanwhile, oil is headed for a second weekly loss following President Trump's tariff barrage. Joining us to discuss everything that's going on in that space, Vikas Dwivedi, a global energy strategist at Macquarie. Really good to have you with us. Maybe I'll just start with the question everyone is asking. Have we bottomed out in oil? Do you think that we're going to get some stabilization around these levels? Brent trading close to $60 now, obviously.
Yeah, we think we're close. We probably should see more downside, but not a lot. You know, I think we were already expecting, our view was $60 oil for 2026 was pretty likely before the tariffs. It was a very oversupplied market, and it was really from too much supply growth. And now the tariffs will probably be hurting demand.
Yeah.
And, you know, when you quantify it, it's meaningful, but not catastrophic. So we think if, you know, Brent trades far below 60, it starts to become pretty good value on the long side.
Let me ask you about the OPEC Plus decision, first of all, because you had a double whammy last week.
Yeah.
You had the tariff shock, which was a demand shock, and then you had the OPEC, which was a supply shock because it accelerated, brought forward the timing of bringing these extra barrels to market. Can I just ask you a big picture question? These barrels that will be put back to market, according to the OPEC schedule, is the market ready to absorb the extra production that's going to be coming, do you think?
No. The short answer is I think the market will struggle to absorb those barrels. It was already going to struggle. And now if diesel demand, which diesel cracks have held up pretty well, surprisingly, but if diesel demand gets hit, which we think it will, refining run cuts become more likely. And you don't need those barrels. You didn't need them to begin with.
Yeah.
Now adding them in this tariff situation is a double jeopardy.
Why do you think they made that decision then?
I think they had no choice. There was never going to be a good time for them to return those barrels. And in this case, maybe there was an opportunity with some potential reductions in production elsewhere, you know, whether it's Venezuela, whether it's Iran, for the rest of OPEC to bring it back.
Yeah.
Otherwise, I think they could have been in semi-permanent cut mode I mean, for who knows how long.
Yeah. So we've spent a lot, but we're in the region, right? So the next segment, we're going to be talking about the impact lower oil prices are going to have on Saudi's budget deficit. But I want to turn you to a different direction and ask you about the pain point for shale producers. At what point does it become not economical for these players to keep drilling?
Yeah, it's a series of levels. So around 65 WTI, they start having discussions about, hey, what is our capital plan? At 60, you'll see some marginal cuts from some of the weaker rigs, weaker fields. 55 WTI, like call it 58 Brent, people will start cutting in earnest. At 50, you have no growth.
Yeah.
And the U.S. is delivering a lot of production growth this year as well, according to our model. But, you know, at 50, that goes to zero.
Yeah. So the Trump administration came in, and one of the slogans of their campaign was energy independence, not only energy independence, but energy dominance.
Right.
How are they going to achieve that if the shale producers are going to stop drilling?
The short answer is they won't. I mean, we've already become energy dominant. So incremental dominance is maybe more accurate in terms of not what they've said, but what they wanted, right? Like, hey, we're the dominant energy producer in the world by far.
Yeah.
I think the goal of the administration was to up that even more. But at $50, it doesn't work.
How is the mood in the industry right now? You're based in Houston.
Yes.
What are people telling you?
There's a lot of apprehension and a little surprise at how fast this has happened. And I think the industry was caught off guard, even though I don't think they should have been, right? I don't think the administration is doing anything they didn't say they were going to do. But this is how things go. When it hits you and you're heading towards your break-even levels, it feels very different than a theoretical discussion about drill, baby, drill.
Yeah. Well, one potential positive area is in LNG because U.S. exports in that domain have continued to go up. There seems to be a bit more optimism there, particularly because when you think about the potential trade deals that could be carved out, one area could be in LNG, the EU pledging potentially to buy more LNG products from the U.S.
Absolutely.
So are you bullish there on what's going to happen?
We are.
Yeah.
Yeah, I'm bullish LNG. I'm bullish U.S. LNG and global LNG. And I actually think there's a bit of a disconnect in the market right now. Everybody's seeing all the LNG coming online over the next few years, and there's a consensus bearishness because of the supply. I think the demand is being under-researched and underestimated. As I travel the world, I can see from talking to our clients, there's a lot of pent-up demand growth for LNG.
Yeah.
So we think it'll get absorbed better than the market believes.
Yeah, so interesting, because it's really good to have you on our show. Great to get your perspectives on what's been going on here. Vikas Dwivedi, a global energy strategist at Macquarie. Now, coming up, our next guest says MENA has been partially shielded by the tariffs turmoil. Carla Slim joins us next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Bersetchi in Dubai. Goldman Sachs says Saudi Arabia's budget deficit may reach $67 billion this year due to, well, we were talking about this in our prior segment, lower oil prices. It comes as oil prices have plunged to their lowest level in 4 years, heading towards its second weekly loss. So joining us now is Paul Wallace, who leads Bloomberg's MENA Economy and Government coverage. Paul, just walk us through the budget deficit dynamics and what lower oil prices will mean for Saudi finances.
Hi, Jumana. Well, yes, lower oil prices, especially when they drop as quickly as they have done in the past week, are always going to have a big impact on Saudi Arabia's economy and its finances. In this case, a Goldman Sachs economist, Farooq Sousa, who's the economist for MENA, has said that he thinks their budget deficit will soar this year to about $67 billion, or 6% of GDP, based on an average oil price this year of $62 a barrel. That's more than double what the Saudi government is currently projecting. And the long and short of it is that if oil doesn't reverse its losses in quite a significant way soon, Saudi Arabia is almost certainly going to have to borrow more money on global bond markets and or cut back on some of Crown Prince Mohammed bin Salman's mega projects. It's difficult to see how it can avoid that without a reversal in oil's drop.
Yeah. Well, the full report is up on the terminal. Very interesting to see these revisions to the budget deficit forecast come through for Saudi Arabia. Paul Wallace, who leads our MENA Economy and Government coverage. Well, let's go out to another economist, Carla Slim, who says that MENA economies are a bit shielded against President Trump's tariffs turmoil. Carla Slim, MENA Economist for Standard Chartered, joins us right now. Maybe let's just pick up actually in the oil conversation, because we were talking about that. With Brent trading at around $65 here, you say in your note that only Qatar, the UAE and Oman remain in comfortable fiscal positions. Are you worried about the fiscal outlook for Saudi?
Good morning, Jumana, and thank you for having me on the show for this quite important conversation. Saudi was already in deficit at prior oil prices before the tariff shock and before OPEC decided to triple its production increase. So the fiscal break-even for Saudi Arabia was anyways higher than where oil prices had been trading since the beginning of the year. What this does now with the downside to oil prices is, yes, increase and widen that deficit, which will mean that potentially Saudi Arabia will have to maybe issue more domestically or externally to cover that wider fiscal deficit. Now, the question that clients are asking is whether we see any risk of projects or capex being scaled back or maybe revisited as a result. So we don't think this is the case as early as this quarter. So we think that for Q2, potentially Saudi Arabia, other GCC economies will decide to look through this lower oil prices because of, and thanks to, external buffers being quite elevated. They can tap into their savings, into their reserves to continue financing these projects. But come Q3, if we're still in such a situation, then potentially we might start to see some of these decisions.
And what do you think the mechanism is going to be? Is it going to be a dialing back of spending projects, or will they just have to resort to more borrowing on external markets?
I think it'll be a little bit of various strategies in the sense that if we compare this to the COVID shock, when we also had a dual shock of something that affected the entire global economy, which was a health issue, and lower oil prices. So in this sense, right now we are facing this sort of dual shock where tariffs are impacting everyone, and the GCC Middle Eastern oil producers also have to contend with lower oil prices. At the time, they adopted lower government spending, but also higher non-oil government revenue. So tripling of the VAT, raising revenue measures.
Carla, initially when the tariffs came out, people were saying that the GCC were a relative beneficiary because they were subject to 10% and the rest of the world had these reciprocal ones. Now the rest of the world doesn't have the reciprocal ones, so they're not in a relatively good position anymore. How do you see the whole tariff discussion affecting the growth trajectory of the region?
We've maintained our growth forecasts for the entire MENA region.
You haven't changed them?
We haven't changed our growth forecast. We haven't changed our inflation forecast as well, because we see that there are some elements and some channels that will negatively impact the region and other channels that will potentially act as an offset to that negative impact. So if we talk about growth specifically, so here we think about the UAE, for example, where trade is a very important sector. It's 13% of GDP, so it's an important contributor to GDP. We had been seeing Asia, GCC, that trade corridor, already growing at sort of 10% year-on-year long-term growth. We think the tariffs might actually add impetus to these trade corridors as well.
As in, the countries of the GCC may lean more on trade corridors, and obviously many of these trade corridors are leaning east now.
And may benefit from a larger market share. So although everyone's concerned that global trade volumes might drop as a result of the tariffs, the market share of the GCC in these trade corridors might actually increase. So that helps.
Can I ask you a question about the price action in the USD? The GCC countries have their currencies pegged to the USD. If the USD keeps dropping like this, surely that impact will be inflationary on many of these economies. But you say no. I mean, you haven't changed your inflation forecast.
Absolutely. So you're absolutely right that there's some level of imported inflation because of the tariffs. But again, they might get offset by disinflationary impact coming from Asia. So the GCC imports much more from Asia than they do from the US. And to the extent that China is going to be cutting prices to try to offload some of its inventory that isn't going to the US, then the GCC might get impacted by that. We also think about steel and aluminium, because although we say that the GCC and MENA is sort of shielded because energy was exempt, steel and aluminium tariffs remain, and that's going to impact the exporters in the UAE and Bahrain. Aluminium is quite an important.
Okay. Quick one on Egypt. There's an MPC meeting next week. What are you expecting?
We've changed our calls. So we were in the camp that we're expecting the easing cycle to begin in April by the Central Bank of Egypt, because real interest rates are at 14% as things stand. But given the global volatility, we believe the Central Bank will opt to refrain and potentially postpone this decision to the next MPC meeting, just so that the dust settles on the global volatility.
Yeah, well, the hope is that the global volatility actually does dial down. If this week is anything to go by, I'm not that optimistic. Carla, thanks so much for joining us. Carla Slim, Standard Chartered's MENA Economist. Thank you. Well, coming up, are Middle East IPO plans affected by tariffs? We ask Bloomberg's Laura Gardner-Cuesta next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Middle Eastern firms planning to go public later this quarter haven't yet postponed plans. That is despite recent volatility in equity markets and a slump in oil prices. To dig deeper into this, Laura Gardner-Cuesta, Bloomberg's Middle East Equity Capital Markets reporter, joins us now. I've got to say I'm interested to hear this, because you've heard about many of these other European companies planning that had been planning IPOs decide to put off the timing because of market volatility. That's not the case in this part of the world. How come?
So essentially, we spoke to a few bankers who've been telling us, obviously, they're not going to launch any deals right now in the midst of the volatility, but they're very much working towards the idea that things will calm down, and they're like continuing with their timeline, saying, you know, anything that's coming later this quarter, we haven't yet postponed. We're still doing the work, which is interesting, like you said, because you've seen some deals in the US and Europe be postponed. I think everyone was watching some flagship deals after Eid, things like maybe Etihad and things like Dubai Holding with their residential REIT. For now, what we're hearing is everyone's just monitoring markets and hoping that things obviously will calm down.
Yeah, what is the mood amongst the bankers that you speak to right now?
I mean, it depends on the day. Honestly, this week has been quite a roller coaster. Yesterday morning, people were much more bullish. I think today would have been, you know, it'll be like a different story. But I think what they're saying is what we need is stability. You can't price in this sort of volatility. No one is going to go to market right now. A lot of these deals don't need to happen right now. Some of the like government-owned assets, you're not under the same pressure as a private equity might be in Europe or the US. You know, you can wait. You don't have to do it in bad conditions.
Yeah. How do you think the lower oil prices are going to impact specific sectors where people had been anticipating IPOs this year?
Yes, I think it depends on the sector, but in general, it will feed into this growth story that has been one of the key drivers that has kept IPOs coming in the region, right? If there's lower oil prices, there's going to be less spending from governments, and that's something that investors keep talking about this time around. We know the Middle East has been like a booming IPO market when other markets were quiet, but this is, I think, a key issue.
Yeah, something to watch then. Laura Gardner-Cuesta, Bloomberg's Middle East Equity Capital Markets reporter. Let's keep an eye on how capital markets activity in this part of the world evolves over the next few months. Now, for a look at some of the other stories we're following, Bloomberg's been told that Volkswagen fears President Trump's tariffs will make its Audi Q5 model practically unsellable in the U.S. The Mexican-built SUV, currently priced at around $45,000, has been Audi's best seller in the U.S., but sources say the carmaker now expects the model to be hit with 3 separate levies, totaling around 52%. Swiss pharmaceutical giant Novartis says it plans to invest $23 billion in the U.S. over the next 5 years to ensure all its key drugs for Americans are made there. The investment will fund 7 new U.S. facilities, including a research outpost in California, and expand 3 existing ones. The plans were revealed as President Trump promises to impose tariffs on global drug makers. And Iran says it will consider expelling international nuclear inspectors and transferring its stocks of enriched uranium to secret locations if foreign military threats continue. U.S. President Donald Trump said on Wednesday he would absolutely consider using military action if necessary against Iran if it tried to weaponize its nuclear program. The comments come ahead of tomorrow's talks scheduled in Oman between Iran and the Trump administration, where talks are set to take place between the Iranian Foreign Minister Abbas Araghchi and the special envoy to the Middle East from the U.S., that is Steve Witkoff. But let's turn back to markets. What a roller coaster week it has been. Still tracking losses, heavy losses for the week. Let me just give you the picture. The S&P 500, with all of the volatility we've seen from Monday to now, is still down 2.4% on the week. The Nasdaq down 1% on the week. So still lower despite that massive upsurge that we had on Wednesday. Yesterday, we pulled back about half of the gains, even more for the Nasdaq on Thursday. But today you can see things are stabilizing somewhat. Sentiment slightly more positive for European markets. You can see there European markets are set to open up 0.4% higher. This after yesterday's gain of 4.3%. You've got the likes of Novartis saying that they're pledging to invest more in the U.S. So perhaps there actually is scope for deals to get done here. And that is what investors are turning their attention to. But the bigger theme for markets this week has been the selling of U.S. assets. We've seen a massive repricing of U.S. bonds, a massive repricing of the U.S. dollar, bearishness at lows not seen since the last 5 years. The dollar continues to get sold versus other assets. So that will continue to be a theme that will play out through the day. Thank you for watching our show, though. This was Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Stay with us for Daybreak Europe. This is Bloomberg.